Hey everybody, we have two very special guests today, Willy Woo and PlanB. I don't think these guys even need an introduction. How are you guys doing?
Good. And the third one being Will, who doesn't need an introduction.
Absolutely. Willie, thank you very much for having me again.
Thank you guys for coming on. I think
Yeah, looking
we'll kind of
forward to
start
it.
with like, what have you guys been up to lately? I guess we could start with PlanB and then Willy.
Yeah, last month has been the most hectic month of my entire life because I guess it has something to do with nating the 63 or 61, if you will. Um, and that caused like 400,000 new followers in that month. It's absolutely crazy. And with that 400,000 comes a lot of questions, DMs, well, a lot of business too. So um, everything is going 10x. Yeah, well, since summer basically. So um, the small setup that I had is growing and is increasing. The team is increasing, business is increasing. Um, it's spectacular, and the price above all of Bitcoin is increasing. So all well here in Amsterdam.
Yeah, I'm surprised you have open channels for your DMs. I closed them long ago just so I have time to go deep into the numbers, because as an analyst, I'm sure you understand, it's like as an analyst, it's you got to have that quiet time where you don't talk to people just to get thinking deep and writing code and like getting down rabbit hole. Maybe that stops me from getting access to interesting new conversations. But yeah, yeah. So anyway, what have I been up to? The latest stuff has been like probably a few people probably understand that I'm more than just doing on chain. I'm a general partner in 3 hedge funds. So right now I'm working on three um, kind of market neutral funds of funds, not necessarily market neutral, some of it's directional, but to just really looking at how to like build a sandwich of different essentially instruments to create a new kind of instrument. Like it's really important for me to have something that's like a cash instrument, but yet can compete and more than compete with the money printing, which is maybe 40% per year. So trying to look at getting a yield above 40%, which is quite doable in the crypto space. Cash and carries like 25%, just doing Bitcoin. And if you really know what you're doing within the funds, you can get much higher. So I'm looking at that. I'm exploring possibilities of building an instrument that can keep up with Bitcoin with much less of the downside, if any. So really, a lot of the stuff is what I want for myself, but some of it is really pertinent to the funds that I'm involved with. So that's fun, and we can talk about that a bit later. I know that PlanB and I have been sort of like talking about Sharp and Sortino and definitions of risk, which comes into it when you build the stuff. Other
By the
than
way,
that,
nice
like
chart on the blackboard behind you.
oh yeah, like there you go. These are normal curves, which are really shit. Yeah.
Yeah, I haven't just keeping up with the content stuff here at Blockware. I mean, we're growing pretty aggressively, so got that,
Mhm.
and as well, we're just adding on new members to the team, etc. So 2 weeks ago, I had my first actual business trip, which I know I sound like such a baby saying this. It's actually my first time flying alone, so I'm growing up a little bit, having some new experiences via Blockware. So it's been a fun time. Plan B, I want to ask you. So you said you were running your own fund now, right?
Yeah, well, it's proprietary fund, so with own money, and it's based on a very inner circle group of people that have their money in that. So it's not structured like a fund; it's a proprietary thing. However, we have started 2 months ago with a strategy that uses algorithmic trading, so automatic trading, and those are running. And I use those platforms and the team to backtest algorithms, and we will talk about that later. To backtest algorithms in real life, and the nice thing is we have the option to open it up for outside money. So we already did that 2 months ago, but very small, very small. There's almost nothing. I think it's 1 or 2 million in there right now. But we probably are opening that up a little bit more next week for European investors and in Q1 for US investors. But we will not. I will not advertise it very aggressively. I will not. We try to keep it small because, if there's one thing I learned is that it has very distinct advantages to be under the radar, not too big, and agile, so that you can move in and out markets without being seen. So a fund should, well, it's always difficult.
It's like you're in a speedboat versus a big cruise ship trying to maneuver, right?
Right. Because if you're 1 billion or 10 billion, and I used to manage with a team, not alone, of course, a balance sheet of 100 billion. You're very well visible. You have to, yeah, you can't do that overnight. And sometimes in this space, you wanna switch positions or rotate out of a position overnight, especially the on-chain stuff. So, we're aiming at keeping it under 10 or 100 million small, but in real life. So real money, real exchanges, and on-chain signals. So it's fun, but that's mainly for testing and building up some how do you call it, performance track record, if you will, because one of the most heard critiques I get is, well, all those models, those are nice, but it's all backfitted to the historic data, and how do you know it'll go on for the future? I even get that for the stock to flow model. Like, it's a nice fitted model, but how about the future? Some people forget or don't know that I made that model in March 2019. So it's running for 3 years now, and as advertised. So it's that's one other thing. And so those algorithmic trading is something I did in the beginning of my career when I was your age, maybe a little bit older, and so I'm very, very excited to do that again now. But my big focus, of course, is on much longer investments, and that will be proprietary. That will not be opened up for outside money.
Longer term, like longer time frame investments, you mean, or?
Yeah. So not day trading or week or month, but at least 1 year or cycles.
Right. Gotcha.
I like I did before. I think it's no secret that I bought Bitcoin in 2015 for the first time, and then sold half after the all-time high in 2017. So it was the beginning of 2018 that I sold at. I think it was 14,000 on average, 13, 14. So I missed the all-time high, which is okay, which I think is very okay. And then reinvested that half that I sold in, just before I published the article in 2019. And I wish to repeat that with my own money and the friends and family's money. So that's basically it. So those are the time frames that we're on.
Now, Willy,
it's funny.
Go ahead, Willy.
Sorry, you go. Oh, it's funny. It's like it's similar here in that I sold 2017, 2018 early, and then I sold all of it actually. And then that was with the very first on-chain indicators. I used NVT. I just said, this is my plan. When this thing dead cat bounces, I'll know whether or not it's a consolidation or actually a dead cat, because NVT will tell you the volume on chain will drop. It was a dead cat, volume dropped, and so I sold everything, and that was the plan, And so that was the first time I used on chain. I put it on my entire crypto net worth, and now I'm like looking at it, and no matter what's happening, because I feel like the cycles are changing. We could probably talk about that later, but my approach has been now, a lot of this work in the composite fund of funds is like, let's bring together a sandwich of strategies, from cash yield to directional, where if Bitcoin's crashing and all crypto's crashing, it can short it and can also gain, and you can pause it all together and really minimize the risk. In a down market, it should still climb. So I'm looking to I really want to get an instrument together that kind of like reduces the need for manual timing of the market. It just has a fundamental behavior that you can rely on that's a little bit more or a little less timing related. And I'll always have a big stash in Bitcoin because that's your sovereign wealth. If the entire system implodes, you've still got your private keys. So I mean, that's, I think, the biggest the biggest reason to hold Bitcoin yourself. I think that you can invest in other very exotic stuff that can keep up with it, especially crypto related. But like Bitcoin's the only game in town for kind of very against the zombie apocalypse. You'll be safe with Bitcoin type of thing, right? So yeah, that's how I'm looking at it.
You do some
And
like shorter term time frame trades, right?
Oh yeah, I've traded from the 60-second time frame right through to the multi-month using on-chain. Like when FTX went online, I was one of the I was a pretty big trader on there because I was trading 60-second time frames. Back then they had just really very smart of SBF there. He put up these very huge buy wall, sell walls. They were like 100 Bitcoins either side of it with no spread. So you could actually just whack it with leverage. And so with at the time I think my trade account was $100,000 and I generated $400 million of volume trading the 60-second time frames. And it's just fun, but you get, I was two things. One was to get my volume up so I could get my fees lower, and to play around with those short time frames. And here was an exchange where you could trade an $8 move and not get killed by the fees. So that was my, so I trade all time frames. I don't really trade the short time frames now because it's quite random. You're really gambling a lot unless you're doing algorithmic high frequency stuff. Whereas the longer time frames, right out to the Michael Saylor type time frames, which is generational, that stuff becomes super, super reliable, right? If you can handle the pain, which I think I tweeted recently, there's only two things you need to know how to get rich with. One is very good understanding about risk, and second, a good awareness of how much risk you can stomach, and so anyone can be rich with Bitcoin if they can stomach the downside and hold on till it reaches the other end, So, that's the whole gamut of different time frames. It's not easy to hodl, as I think, it's PlanB definitely. When did you get into, when did you buy your first Bitcoin, Will?
Oh gosh, this is gonna be a little embarrassing. It's August of last year.
Oh, okay. All right. That's not bad.
A good entry point.
It's right. Yeah, it was literally right before we started ripping up.
Yeah. It's funny. Whenever you buy Bitcoin first time, you always feel you're late to the game. I bought December of 2013 in the, when I think it dipped, it crashed to 600 from 1200. And I bought my first one Bitcoin. I didn't know what it was. I just thought, it's like digital gold. Let's have a shot at that. And but I felt like, gosh, I'm so late. It dates way back, and you hear all the OGs talking about it in the white paper and Silk Road and all those. It's almost like mythology now to me. Some of those early stories of Bitcoin. So,
how do you feel like the market has evolved? I mean, this is directed towards you, but PlanB, if you have any thoughts as well, how do you feel like kind of the flow of capital, liquidity has gotten better, et cetera, and just how the market's traded, just talk through how that kind of evolution has taken place. Like I remember listening to, Kobe from Twitter talking about how like in the early days, Bitcoin would trade really cleanly based off of just basic TA patterns. Like, you see like an ascending triangle would play out exactly how you'd expect versus now, you have all these algos in on the short-term time frame. So how do you kind of see it, as like, how's that process evolved?
it's kind of my education to mainstream finance, really. Bitcoin is to watch it evolve. The complexity is much higher now, and it's now just starting to approach what I imagine is what you see in mainstream markets. It's complex, right? You've got like hundreds of exchanges, you've got derivative markets, futures, options. You've got lending platforms. You've got, you know, thousands of different coins, and they all come into the ecosystem. And Maximus might say, well, the shit coins are shit coins, but actually they are part of the ecosystem, and you can do some pretty interesting things with it. And what goes on in one part of the ecosystem impacts the other. So there's a very complex relationship. Like if you were to talk about the thousands of shit coins, they, you know, like you could do statistical arbitrage where you're like, you're going long and short different types of really, you know, tiny assets, but there's good yield in it, and that yield actually runs an arbitrage to the main markets like Bitcoin and Ethereum. So it's very complex relationships, and there's like all these different parts in the ecosystem you can sort of eke out revenue, profit, you know, and like, you know, I'd say 2017 was last year where it was very purist. It was all on chain. You'd see the huge volumes on Bitcoin's blockchain because everyone went through Bitcoin to clear their funds. And they'd buy the next ICO or the next investment thing, or they send it to exchanges, and everything went through Bitcoin. The volumes were huge. And then like along comes BitMEX, and they're doing Bitcoin-based futures, and they introduced the perpetual swap, and suddenly huge volume started to ramp up, and with 100-to-1 leverage, and then that was when you started to see some very, very visible, what you say, manipulation of the markets, because you had this thing where on one exchange you could manipulate the markets, and you know, you may call it manipulation. You might say this is a full-on, no holds barred game of markets, where, you know, everyone's incentivized to beat the other guy, and if you've got a lot of capital, you can push the market around. So you start to see the BART patterns in Bitcoin, and you can look at before end of 2017, very smooth parabolics, very, very textbook accumulation bands, and now after BitMEX, zigzags, BART patterns, you know, $3,000 cliffs from six, you know, it drops 50% in like 2 days, and then, you know, it becomes robotic. And so that's the difference I've seen. And like now it's just more and more complexity with the ETFs, which are futures based. So, you know, you start to build this like machine in your head of how all the different bits back onto each other, and then you just got to calculate bits, which is what I try to do, is try to add quantity to the bits and try and figure out what may happen next. So that's that. I imagine PlanB's got a different view. I'd be interested in that because you come from traditional, so you already have that understanding and you know what it holds as it's coming in.
I was about to say, I don't consider myself a real Bitcoin OG, by the way, because I read the white paper for the first time in 2013. So I missed the first 5 years, and those, those seemed like the real cowboy years where the big changes happened. But I see the Bitcoin market as a very small market still. It has grown, but I mean, when I wrote my paper, it was under 100 billion. So it was 60 or 80 billion. When I started investing in 2015, it was even smaller. But and those are that's like not even a big cap stock in the S&P 500. It's really, really small. So for an institutional investor, it's it was a game, and you know, if you're used to trade and invest in the bond markets and the equity markets and all the very large derivative markets, the interest rate swaps, etc., mortgage portfolio, structured finance, it's all in the billions and billions per deal. So, and I've seen Bitcoin grown over the years. So especially 2017 when the futures came, that was a first step. And I want to tell something about futures because a lot of people are scared about futures, and they think that they will be used by governments to manipulate markets, etc. But for me, as an institutional investor, it's a sign that the market is getting more mature, like an option market. For example, as an institutional investor, I wouldn't invest in a market where there's not a futures market, because a futures market is another way of getting rid of your exposure. Instead of selling the asset, you can go short the future. And for example, if a market is closed, because that sometimes happens, right? I went through the 98 crash, and then the 2000 crash with the the IT bubble, and then the 2008 crash with large exposures. And sometimes markets are just shut down, and then you're so happy that there's a futures market, maybe in another time zone, where you can get rid of your exposure and hedge your positions. So the but there's one story I want to tell about futures, that maybe a lot of non-financial people don't know. But did you know that the Romans already had futures for their olives trading? Right, there were olive farmers and olive oil. And the thing was that there was one big risk for those farmers, and that was frost, right? The weather. If the winter was bad, if there was frost, then the whole olive harvest would be gone. So it's a zero or everything game in the spot market. So they have to invest upfront in the land, work for the land, and then get the olives and sell them in the end. And they have everything or nothing. And then came the futures market. So there were some rich Romans that said to these farmers, "Hey, how about I buy your olives right now. I have to give you a lesser price because of the risk involved of the frost. So let's say 80%." And the farmers were like, "Yeah, of course, get rid of the risk. You take that risk, and 80% is okay." So now a lot more farmers were willing to take that risk to have the money up front invested in the land with their hours, and make the olives. And the rich Romans that did those future buys, they could of course spread that risk, because they do the same deal with another farmer a little bit more south in the country, or at another country altogether, and they can sort of hedge their positions where the farmer alone could never do it. So for me, even the futures ETF, it's a great thing, because ETFs are a bit scared about Bitcoin and the custodian thing and the keys and all, but they know futures, so they're happy to pay 10-20% premium, and for a long position, and take that as a cost. But they don't have that risk of custodian and all that. So, and there's of course the other party that takes the sort of risk neutral return of 10, 20, sometimes 30%. But they do have the custodian risk, and they have to ship around those Bitcoins. But in a way, it's the same risk that's just being split between two parties. And I think that's a great thing, because that opens up the entire market for more players, more farmers, if you will, in the Roman example. So yeah, I think it's great. And we'll see a lot more maturing of the market, with spot ETFs, which will come with countries entering, with central banks putting it on their balance sheet as a currency. The future will be great.
Do you think when I don't think it's if, when spot ETFs are approved, and when they're approved in Canada, they're not in the US, but if they're approved in the US, do you think that a lot of the business will drop out from the futures ETFs? Do you think they'll even die because the contango rollover, the cost of maintaining that exposure through the proxy of the futures market, it comes down to sometimes 20% per annum. So do you think that like once a spot ETF gets approved, that the futures ETFs will be phased out, or do you think they will coexist, and why?
Maybe no, I don't think so. Maybe maybe I'm wrong about there, but I think some funds will be happier also in the future holding futures instead of Bitcoins, because futures they can put futures positions in their systems, their IT systems, their admin, their whole back office systems are built for traditional instruments and not for Bitcoin. So unless they also upgrade their backend to yeah, say custodian with one of the big parties, there will always be some entities that prefer the futures position, because it's a
I
very
mean, the futures ETF, I mean, the front end for the investor is either a spot ETF as an equity
yeah.
vessel or the futures ETF, whereas one will be tracking less directly. The futures will be tracking less directly, and it will involve, a much higher annual fee to keep going.
Yeah, I think they'll stay. They'll coexist. Maybe the spot funds will be more Bitcoin only, and the futures funds will be maybe with some volatility harvesting or
Right, I see.
some additional things on there. I think they will coexist. There will be an exotic explosion of fund categories.
Oh, yeah, I guess because the futures will be a different instrument and it'll behave different. And whenever it behaves different, there's opportunity.
Yeah. You could put leverage in there a little bit, etc.
Yeah, you can short it more readily than like a spot.
Like that. Yeah. So there will be different animals, I think.
Yeah, no, that makes sense.
What do you guys think about like the evolution of the options market? I've listened to Sam Trabuco from Alameda talk about this before, and he thinks that the options market isn't quite large enough in size to have a major impact on the Bitcoin market, but over, say the next 1 to 2 years, it will. What do you guys, think about that, if anything?
Yeah, maybe two things. I think it's another step in the in maturing the market. So it should be there. It will be there. It is already there, by the way. But small, like you said, and it's a way of hedging your position. It's also a way, the comfort call writing, for volatility harvesting. So volatility, so the high volatility in Bitcoin that is seen as something bad right now by traditional investors, that same volatility is an asset in itself. You can go long volatility or short volatility, and I think the classic mistake that retail investors make is that they do directional bets with options. You should never ever do that, because volatility trading is the goal of options, and not taking directional bets. So you will so pricing that volatility and making money of the guys that do directional betting. That's basically what it is. Like with futures, you can squeeze out the money from people that take too high leverage, 10x, 20x, 100x. Those are the losers in that game, and the cash and carry guys, of course, are the winners. And with options, that's the same thing. There will be a lot of directional traders in there. Those are the losers, and there's a lot of volatility harvesting companies, and that's an entire different brand, a different investor on its own. The volatility trading is beautiful.
I'm going to ask you a question. You're probably the best person on the planet to answer this, PlanB, because you trade options and you're an on-chain analyst. And like, it occurs to me, with the options, taking the directional bet with options, and I know people that, very notable people that actually trade options directionally using your stock to flow model as the valuation time frame model. But with on-chain, you do get a direction, you do get like a time frame. You do get like right now I'm looking deep, well, not deep, but like early to mid 22 looks like a bull season. So we can get these kind of 6 month out or more signals, and so that's a directional bet, and you got a time frame, whereas an option is a direction, which is a price, and a time frame. So it seems like those two match. And like, if you've got good on-chain modeling, do you think that that changes your view of like, you shouldn't be taking directional bets, you should only be trading the volatility and harvesting?
Yeah, no, that does not change my view. I think you should never ever do directional bets with options. I think futures are much better in that, much more efficient. Because if you do directional bet with options, for example, now the price is 60, the stock to flow model says 100. You could look at those call options for the next couple of months, year maybe. But you would pay probably 80 to 100% implied volatility. So even if you would be directionally right, you would still.
Gotcha.
I don't have the prices in
You're
front of
paying
me.
an overhead in the cost of the volatility.
Yes, it's like the
things,
contango,
yeah.
like the futures ETFs that have to pay the base rate on the the contango spread. If you will,
Gotcha.
in the
Gotcha.
you'll have to pay the volatility premium, and that is calculated in with Black and Scholes formula, of course, or even more complex models. That exact formula is or that exact implied volatility is traded and calculated in a way that the ones paying the volatility always lose, or the ones that buy the volatility win. So it's the chances of making more than that volatility that's priced in are low. That's what I wanted to say. But then again, it's a world on its own. Volatility trading is the most exotic, the best way of, especially and it might interest you really if you're looking for passive income. Volatility, seeing volatility as an asset is perfect, because that
totally.
gives passive income, and volatility is the one attribute that Bitcoin has, of course, and that's hated by a lot of people. But there is no volatility in equity anymore, or bonds.
Yeah, well,
or
we're
real
running a
estate.
project right now where we're looking at that in the options market to trade the volatility and get yield. And these guys come from the traditional market, so they were very well versed, and they're just like, big wide-eyed and going, "Whoa, look at this market." I mean, I think the comment was, "Okay, so all we have to do is actually do the work and bend down to pick up the money."
That's it.
Bend down and pick up the money. Yeah,
that's the same with futures cash and carry, of course. I mean, for a normal pension fund or life insurance company in this environment, with especially in Europe with zero interest rates, if you make 4 or 5% on your portfolio with limited risk, that you're king. You're king of the hill. So imagine 10 or 20% on a cash
and
and
it's
carry
the
trade,
most conservative kind of delta neutral trade you can do.
Exactly.
I'm like looking, the really good funds in the space can do 100% per annum. They're the really good guys, and they're doing everything in crypto. They're arbitraging, DeFi to traditional, like to centralized exchanges, and like everything. It's just like the arbitrage across altcoins. So anyway. So
it is arbitrage, like you say.
It's all arbitrage, buy and sell in a guaranteed win. And the only loss is counterparty risk and APIs going down.
Right, absolutely. That's the one reason I left traditional finance, because there is no yield to be made there anymore, and all the volatility and thus yield is in digital currencies, Bitcoin.
Like if you can get that down pat really well, handle all the downside risk, like don't get screwed when all the APIs fail, particularly Coinbase, and take advantage of the leverage available. You can get returns that are similar to Bitcoin with minimal down risk, very minimal. Like it's just, if something breaks.
Maybe I remember, I think this might have been at the end of last year, you did a podcast and said something like really resonated with me. It was you were thinking about volatility in the sense of whack-a-mole is the game, where you have all the groundhogs popping out and you got to hit them with the little hammer. And you basically analogized it to this, and you said, all the holes have been plugged, but the volatility still has to go somewhere, right? It's not in bonds, it's not in equities anymore. It's now in Bitcoin. And so you have all these opportunities to harvest that volatility, like you said, and that kind of framework of thinking really, really resonated with me. And then one other thing, we were talking about like the cash and carry trade. I think it's really interesting now that like the CME curve is in pretty heavy contango versus earlier this year, you had a lot of the more overseas exchanges, right? So a lot of the US investors couldn't get access. I mean, they were doing the grayscale arbitrage, but they couldn't get access to, this specific arbitrage trade, the cash and carry trade, just because of regulatory restrictions. So now that the CME curve is getting bid out, you look at like, the 3-month basis is starting to get bid out pretty aggressively. I think some of that is from the demand for the futures ETF. Some of it is just people getting exposure through the futures. But I think now you're opening up this whole other pool of capital in the US that wasn't able to do this earlier this year. And it's free money, right? I mean, we're looking at, the treasuries at, less than 2%. I mean, they need to get yield somewhere. And here they can just, get this easy, just long the spot, short the futures, and just harvest that yield all day long.
We saw, I think it was the numbers, like maybe CME was doing 20% on cash carry, and you might be able to do 30 or higher on Binance or FTX. And I mean, I viewed that as like there was a lot of Wall Street players that understood this trade and they could only trade it on the CME. So the yield was being extracted by traditional funds that had gone into crypto, whereas exchanges like Binance were more exotic exchanges that only offshore people had. And like, here in Asia, which is actually, I think the numbers are that is like there's more crypto money in Asia than anywhere else in the world. And over here, we're all just DGen traders, like DGen, like they're doing crazy amounts, like a lot of the money that went into Ethereum came from Asia. A lot of the financing comes. So they're doing a lot of these primary rounds and less interested in the traditional Wall Street stuff. And so there's less capture of that free money, so to speak, in Asia. So you see that that's not being pulled down as much to equalize, whereas now we've just had the futures ETFs coming out, and that's just really boosting up the contango in the CME, and that's kind of bring it back into line, and so I think that's the dynamic that's happened. But yeah, it's really interesting. Different regions do different things. And probably one of the best things I did was to come to Asia for a bit and take a look at the scene. Yeah, it's quite different.
Yeah, I kind of want to pivot the conversation now to on-chain. So,
Okay.
We've been talking for a while about like derivatives and stuff. So Willy, I guess if we could just start off with like super high level, just what is on-chain, and talk about the evolution of it, since you're kind of the creator of it.
Okay, so I wouldn't say I'm the creator of it, but like I was definitely early in making it popular. There's two views on-chain analysis. One view is a cheat code, the cheat code, which is, well, it's an open source network and it's a visible ledger, and you want to see all the trades that are happening, which is exactly what it is. It's every single trade, which is it's not a day trader, it's an investor. One person sells out, one person buys in, and the coins move, right? Because the majority of this network is an investment network. It's a store of value network. When coins move, it's going from one investor to the other, or one investor to an exchange, one investor to OTC desk, one investor to a custody provider, So those moves are very, very visible. So that's like a cheat code. And then the other view of on-chain, which I think is now starting to die away, I think with the likes of us being more proactive in communicating. The other view of on-chain is it's snake oil, right? I think you've had that as well. So
over summer we got a lot of that.
Yeah, but I always felt that was great, because it would the more snake oil talk there is, there's more ability for the people who do use that, which is I do. I trade relatively large volumes using on-chain, and the more people doing it, the less kind of alpha I will get. Everyone's doing the same trade, so you're not trading differently. So yeah, on-chain is really that. It's like a visible view into the ledger, and you're effectively looking for movements between investors and seeing their trades. And now I'm at the point where really the only thing I'm looking at, there's two things I'm looking at, but the only thing I'm looking at in a trade is to essentially look at different views of demand and supply. Where's the demand and where's the supply coming from, and where is it overwhelmingly a demand space versus it's a supply space? The other thing that I do is really, it's a great forensic tool. So if anything happens you can look at it at on-chain and at least get a data-backed explanation of what could have happened or what is happening. Like when recently we had China ban Bitcoin for the nth time. This time it was banning the miners. So we had a mass exodus of miners, and you could look on chain and go, oh, okay, there's a hash rate plummeting. There's a lot of miners selling now, presumably to fund their migration to new locations. So you see all this stuff happening as well. And so, often reporters contact me and say, what's happening? Because this, and this. And then you can kind of look on chain, hundreds of charts and go, this, and this is the signature of what's happening. And you can wrap a narrative around it. It might not necessarily be correct, but at least there's data to support that that's probable. So that's on chain. It's effectively, if you're trading equities, an analyst might go into the company and look at the books and talk to the officers in the company and talk about the next products coming out. And in Bitcoin, it's not a company. We just talk about we open up the company, which is the network, and we look at what is the fundamental activity. And of course, that stuff evolves and changes over time. So you need a good understanding of Bitcoin as a technology and all the different parts of the ecosystem.
Yeah, totally. The way I kind of like to analogize it is almost we have X-ray vision of what's going on the blockchain, right? And we can see through and track what all the different participants on that chain are doing. PlanB, when did you start getting into on-chain modeling? In addition to your stock to flow and stock to flow X model, I feel like I didn't really see you doing any on-chain modeling until earlier this year, but maybe correct me if I'm wrong. And are you still pulling data from your own node? Because I know Willy and I are mostly just using Glassnode, but I remember we had a conversation a while back and you said that you and a group of other quants are actually kind of sorting through the data on your own.
Yeah, I remember that conversation. I remember saying that we were miles ahead of Glassnode. I think that's true, by the way. But we were late. I was late in the on-chain game, I guess. Late 2020 that I started. Of course, you could say that stock to flow is on-chain as well, because to measure the flow, I had to measure the new coins that are created in the subsidy that are created in each block. And I actually take the real data. That's also why that model line is a bit wobbly, a bit curvy, right? I get a lot of questions about that, but that's because I measure the actual blocks that came in a month and the actual subsidy in there. What you see if you do it is that there's sometimes a stupid miner that forgets to put the subsidy in there for himself. So there's a block with 0 subsidy, and all kinds of weird stuff happening even in the stock to flow. So stock to flow is uses that on-chain input, but in the beginning I took that from a website, of course, but I realized there was a lot going on under the surface. So mid 2020 I started to really run a node and extracting data from that node. And I guess that's indeed a big difference between you and Willy and what I'm doing, because you're using Glassnode's data that does all that data extraction, etc. But where I was maybe more nerdy in trying to do that myself. Running a node is very simple, but extracting the data, which is then the first step, is very time consuming in that you need programming. I'm a lousy programmer. I can do programming. I do it in Python, but I have programmers around me right now that are like 10 times better, like wizard programmers, and they can do it with their eyes closed in 10 seconds, where I would spend the whole day. But you need hardware as well. So the UTXO set, you have to simulate that UTXO set going through time, and that with 64 gigabytes of RAM, you cannot do it. So we're using Xeon processors, clusters of Xeon processors that have sometimes more than 1 terabyte of RAM to do this in a timely fashion. That's a very exciting part. But then that will be the first step, right? Getting the data off. You guys let Glassnode do it. and then go to the second step directly, and that's the info that you get from there, and looking at the metrics and making charts and doing correlations. That's of course the fun part, right? And but for me as an investor, I am actually more focused on the next two steps, because I see this as a 4-step process: data, information, charts, and then, but the next step is making trading rules. So not just eyeballing correlations or making charts, etc., but making rules. If metric 1 is below X, buy, and if metric B is sell. And then the 4th step is backtesting those trading rules, see how they work in the last year, 3 years, 5 years, 10 years, and then you come into this world of risk return that Willy has been talking about in earlier podcasts, and I hope we can talk about it right now as well. But that has been the focus all my life in traditional investing: risk and return. What are your rules, investing, rotating, or trading rules? And you just use the on-chain signals for the input. But we're spending like most of the time making trading rules, also letting the computers find grid search those rules, right? And then simultaneously backtest all those rules against data, historic data of at least 1 or 2 years, but preferably 3, 5 or more years out. And then the entire game, once you have the data and your metrics and the rules, the entire game becomes optimizing risk and return. And how do you do that? Because do you use Sharpe ratio? No, that will fail. Well, it's not the best. Do you use drawdowns and Sortino, like Willy said in the other podcast? Probably not the best one either. So how do you do it? And that is the magical sauce. And I think the area that I'm very specialized in, and maybe a little bit beyond the pure Glassnode, and yeah, and yeah.
It
Willy,
just really does come back down to risk, right? It's like defining risk in a very specific way.
Yes, yes.
Like making money is all about defining risk. I think it all just ends up like that. Hey, I'm interested in, like, you're saying that you think you're a step ahead of Glassnode, and can you expand on that? It was like, what are you doing that, without divulging your trade secrets? Like, what is the approach, or why you think it's ahead of Glassnode?
Well, yeah, maybe that's a bit rough to say, but I see Glassnode is really putting a lot of energy in the putting the data out, making it available, making it clean, putting also some analysis on there, but not doing trading rules, of course, because that's not their business. So they stop at extracting the data, making the metrics, making them available, and their business model, of course, is selling that data that people like you and me, by the way, because we have a Glassnode subscription as well. But the fact that I see it as a 4-step process. The fact that you simultaneously do trading rules and backtest all that stuff, you see that second step, you see that as a feature extraction step. That's a term. Feature extraction is a term from AI. I did that in my younger years, by the way. Neural nets, genetic algorithms, etc. So a feature extraction from the data is a way of structuring that data that it can be used for an AI or a trading rule optimizer, a grid optimizer, grid searcher, that optimizes that risk return parameter in your backtesting. So we're very focused in looking at the features that data gives us, and
Gotcha.
not
Yeah,
so
I see. Yeah, I see the difference. Because like Glassnode is one-dimensional business that provides data, actually effectively to funds that like are like charged with creating these rules and trading. And I guess one of the advantages you have is you have a full vertical integration, so you're always going to get a lot tighter communication between each of these layers. Whereas
Right.
when you're using Glassnode, you've got good data about it's one step removed from full vertical integration of each layer, and which I always saw that as a strength of what you're doing. I mean, I messed around with the base data, and it was like, and this was like, gosh, it was like 2015 or 2016. And it was like, oh gosh, this is going to take heavy lifting, like just indexing it. And I was doing it on my laptop at the time, indexing it and just running queries across the index set was taking minutes, 10 minutes at a time. And like they were like very efficient queries. And once you got into complexity, it was like, oh, forget it. You'd be waiting for days. So yeah, there's a lot of data to move and to search.
Sometimes like I want to make certain metrics, but I need access to that base level data. So I'll have to like message, Raphael or somebody, but, I can't actually just, take a ratio of it or, compare something or do standard deviation or all these kinds of things. Like I'm limited to only being able to do things on top of the metric that they've already put out. Whereas, like you said, Willie, PlanB has that advantage to go into the base level and still be able to extract different metrics in that sense.
That's it. And I imagine you guys are very close contact with Glassnode. Like, can you make this? Can you make that? Give me one level deeper information. And it's the vertical integration, I guess. But in the end, we're all doing the same thing, right? It's data but in the end, like Willie says, it all comes down to risk measure. How do you measure the risk, and how do you optimize basically on those two criteria, risk and return? Why is a certain strategy better? And the whole point is not to do overfitting there, right? You can really maybe prevent a 2018 crash, but then totally miss the next crash because your whole system memorizes and not generalizes, but memorizes the 2018 crash. And how do you stop an AI or a statistical system in general from overfitting a curve and extracting exactly what is useful for the future, and not more.
That's a huge challenge. I mean, that's my experience is if you build rule set algorithms and train it on past data, it just loses its tune. It's almost like you got to retune it as more data comes in. And in particular with Bitcoin, I was doing technical rule sets for technical trading, and they got pretty good. It was like 60% reliable per trade, which is very good. Like you can make money off 50% if you got good risk management. Like then it would lose its tune because the trading charts of Bitcoin, the price charts keep changing as it evolves and more sophisticated traders come in and different kind of strategies people are playing off against each other. It really changes the price chart, and on-chain's no different. And I think it's even more so. Like on-chain data keeps changing. You can see like recently, like this year, we're in a regime where the volumes completely dropped off because we're moving things on derivative exchanges and on layer twos and even onto altcoins, and where Bitcoin used to pass through, Bitcoin doesn't. So all that stuff changes, and it becomes really challenging to try and train these rule sets with a very shifty moving ground underneath you. So it's a challenging, very challenging task there to do solid rule sets that can span off into the future for a reasonable length of time.
Yeah, no, I also think about it as all these different metrics that we have available are basically like a toolkit, right? And you kind of have to know when to pull out which metric. And so that can be a bit of a challenge at the time. It's just understanding the environment that you're in and which tools are kind of appropriate to use. And that kind of actually segues into the next topic I wanted to cover is let's just kind of talk through the anatomy of a Bitcoin full market cycle. And then eventually we'll get to your differing opinions on the structure of the cycle moving forward. But historically, what have been kind of the behaviors or investor behaviors on chain that have resembled a bear market and a bull market, and kind of break down how you guys view the anatomy of that whole process? I guess we can start with PlanB.
Yeah, to be honest, I view the on-chain. I think the on-chain analysis, for me at least, is most valuable in identifying tops and bottoms. So identifying FOMO transactions, if you will, at around the all-time high, and panic liquidation kind of reactions or transactions in a bear market, at the bottom of a bear market. So, and you know it when you get there, right? So I could not say what the top of the market will be right now, because we're not in a FOMO situation. So at least I know we're not in a FOMO situation. So it is not the top. But I don't know when the top is, and that's that's of course the difference with the stock to flow, more fundamental model that has gold data and stuff in there, that you can very, very roughly say something about the level. Yeah, you could expect the next Bitcoin price level to be, but on chain. Yeah, so at least I can say we're not in a bear market right now, and we're not at the FOMO end of the bull market. So we must be somewhere in between. There's several technical indicators that also say the same thing, and yeah, so given that fact, I would extend the current uptrend with a couple of months. And that brings us, yeah. Well, I mentioned the numbers before. Of course, the next 2 months are very well known. I think we will end in the roughly at 98 at least this month already, which is huge. Nobody believes it. And then 135 in December, at least. And
if
then
I can just cut you off for 1 second, sure. I just wanted to say, like, I think kind of what you're getting at, and something that I've been thinking about lately, is you have a lot of people come to you and say, when is the top, right? Like, what's the exact price and what's the time? But it's not that. With on-chain, what you're really looking for is what are the behaviors that resemble euphoric behavior from these market participants, right? I think that's what you're trying to get at here.
Yeah, absolutely. Yeah, I'm not interested in the top at all. So I don't know when it is. Yeah, when we get there, I know it, but I don't know where it is. I'm not interested in that, because I know it will be probably a 1 minute spike, right? I cannot trade it. I cannot sell or buy at that price level. I'm more interested in the general level where it hovers around, where it will. Yeah. So no, it's exactly like you say. So, but still, I think we'll go on in Q1. Because that's another thing you can measure from on chain. You can see the shortage that we're all talking about. How many Bitcoins are there? And you guys are really looking at coins at exchanges, and are they leaving exchanges to cold storage or coming at exchanges? But I'm looking at it at an on-chain level, and then you see that shortage building to a moment where it pops, and we're still without telling what I'm looking at exactly, but we're still months away from that popping moment. And so I would say the top is at least 3 to 6 months, maybe longer away. And I want to make that very clear, because when I type PlanB in Google, the first 3 things you see on in the search results are big crash is coming. PlanB says the market will crash imminent. I don't know how these outlets come to that and attach my name to it. I really don't think a crash is coming. I think we'll see a bull market that goes on for at least 6 months and bring us in the 100,000, 200,000. I wouldn't even be surprised with 500,000 Bitcoin in early 2022. But when we get to the sketchy part, when the FOMO transactions flow in, and you can detect those transactions, they are very distinct, then well, we have to all be a little bit more alert, right?
One of the things you talked about was the supply shortage, and I think I've stopped looking at the exchange balances alone at kind of the forefront of my analysis, because a lot of that has to do with just like the entity clustering that Glassnode does. And they had, Willie brought this up to me actually. They don't have a couple of the major, spot exchanges. But what I have really been weighing heavily in my analysis is this metric that Glassnode's created. And actually, once again, Willie suggested this to Glassnode, is illiquid supply. And so over summer, I messaged Willie and I was like, hey, man, have you ever run the ratio of illiquid supply to highly liquid and liquid supply? And so the way this is defined with Glassnode is these are entities, so forensically clustered addresses, that take in and don't sell at least 75% of their coins, right? So, for every 4 coins they take in, they hold at least 3 of them. And then the highly liquid guys, they're selling, over 75% of the coins that they take in. So they're only holding 25%. The liquid guys are 50-50. So when you run the ratio of the illiquid to the highly liquid and liquid guys, you get this metric we created called illiquid supply shock ratio. And this is actually one of the main metrics that I think we both use, but I don't want to speak for Willie, but for me, I used to call that reversal over the summer, because you saw that these long-term guys were locking up coins as price was grinding down. So you kind of had this bullish divergence per se. And so seeing that metric has been one of the main things to kind of look at that. We're talking about supply shortage. And then also Willie, once again, ran a ratio of the long-term guys to the short-term guys. So instead of defining these entities by their spending behavior, we're just solely looking at the amount of time that coins have been held in their wallet. So Glassnode uses 155-day cutoff, which is 5 months. And the reasoning is because they've done like some statistical studies, as that's kind of the where the likelihood of those coins being sold drops off the heaviest. As a coin is held in a wallet, the longer it's held in a wallet, the less likely it is to be sold. But at that 5-month threshold, they found that that's kind of where that likelihood really drops off pretty extensively. And so when you run the ratio again of the long-term guys to the short-term guys, you get this long-term holder supply shock ratio. And so that's really interesting as well, because we've reached like basically all-time highs. I think we had reached a previous, higher level in the metric in like 2011. But in recent Bitcoin history, we're pretty much we reached unprecedented levels. You're now starting to see that roll over, but there's just another way of showing like, you had these longer term investors that really locked up a lot of supply. And it's natural bull market behavior. Now you're starting to see them distribute again. In bear markets, you see the long-term guys, buy pretty heavily. And then in bull markets, you see them distribute their coins as the short-term speculators come in and buy their bags basically the whole way up. Right. But it's been really interesting. And I think this has been part of my thesis as well as to why this bull market probably extends out till next year, is now you've had this behavioral, trend that you usually see at the bottom of a bear market, where you have what Willie posted this chart a couple of weeks ago. It says peak hodl. That's basically showing where the long-term holder supply shock ratio kind of peaks out, right? And we've reached that in the middle of a bull run. And so that's completely different market behavior than what we've traditionally seen, because usually you see that peak hodl in the midst or bottom of the bear market. So yeah, I completely agree with you. And also you can look at the exchange balances, but I think also in just the behavior of investors, you're definitely seeing that supply shortage per se.
Yeah, we're definitely peaked, but it has peaked and now it's like moving sideways and almost down. And that movement downwards means these long-term guys who bought for the long haul are starting to sell it out. And you only see that in a strong rally. And I guess this strong rally has been enough for them to start to divest in their exposure. The last time we saw these guys divest was in the run up from October last year to, the heights of 60,000. They started to divest and unload because they were making, 2x, 3x, eventually 6x on their money. And they divested into a new generation of holders, which were buying it up at the 10, 20, 30, 40, 50, even $60,000 range. And so those are now our new, long-term holders who have held for more than 5 months. And as we see this run up that we're thinking into next year, through into the first quarter at least, it'll be these guys that'll be divesting and selling to the next generation of long-term holders. So the cycle repeats a lot, but we're at that moment where the long-term guys that just bought in on the the start of this year rally. They're fully loaded up and they're at maximum amount of coins versus the rest of the people, and they're ready to sell. And into this next rally. And which is a really interesting thing. It's healthy because you get this sort of new participant in, they accumulate and they sell. And every one of these cycles, you'll get further distribution of the coins and a wider and wider distribution, a higher or a better Gini coefficient, which is a measure of distribution of the wealth within the network or within a society, which is what we're really after if Bitcoin's going to succeed as a monetary base. So, this is, we're looking at it as trading signals, but someone more fundamental, maybe an economist would be looking at that as like, these are the cycles of distributions of coins. Like someone buys, makes some money, they sell, and it gets further distributed. And I've got a chart, like I've been trying to track the whole ecosystem to see how well the stuff is being distributed. And so, it's been a 12-year trend of more distribution, and a lot of people say the whales are dumping, and actually the whales always dump, and they dump into every bull market rally, because why wouldn't you when you're worth $100 million or more of net worth? Because
Hey, Willy, can I ask a question here?
Sure.
Because that's one thing I wanted to know. Can you, in that ratio and in that analysis, can you distinguish between a whale actually selling or a whale reorganizing his wallets? So, for example, I know for myself is if you have a lot of bitcoins in one address, and the Bitcoin starts to rise 6x or 10x, all of a sudden there's a lot of money in one one string of numbers, and you have that urge to reorganize that into 10. You distribute that in 10, but those 10 addresses are your own addresses. It looks maybe like
well,
yourself.
this is not address analysis. This is reliant on forensic clustering by Glassnode. I think Chainalysis do this very similar stuff. So we're looking at the address spaces that show interaction between each other. And so, that's all taken into account. That's actually how we're measuring effectively the closest thing we have Gini coefficient. I'm still asking the guys at Glassnode to give me a little bit more data so I can calculate Gini coefficient over time. But like, this is definitely taking into account multiple wallets owned by one participant. And actually I do another thing where I'm measuring what the whales are doing, because the whales are like selling all the time, but they're also interestingly very experienced, and they do take the odd speculation where they stop selling and they buy. And we saw that as we ran up above the 30,000 lows recently. They stopped selling and they started buying. And there's only a few events in the history of Bitcoin where they stop selling and they start buying, and they're always followed by a multi-month bull run. But in the most part, like the whales are selling. Whales, anyone who owns more than 1,000 Bitcoins. And then you've got another category which own more than 10,000, and they're like almost extinct. They're almost depleted.
And we filter out exchanges and everything.
Exchanges, Grayscale ETF, all these other outliers, we're filtering those out to get down to the individual whale investors. Like this kind of study requires a knowledge, and it's beyond on chain. You need to look at, public filings of public companies and take, MicroStrategy out of the equation, because it's a publicly owned company owned by shareholders. And it gets onto that. So I ended up doing a lot of that work as well. So there's a lot more than just on chain. The ecosystem's getting to a complexity where you need to actually understand how it all works together, and you end up needing data outside of the on-chain world to at least look at this kind of stuff. If I'm going to look at what, we often see these faulty analysis by analysts doing on-chain, and they go, the whales are selling, and they look at address space analysis, or they might even look at entity analysis, but they fail to recognize that the biggest whales in the space are Binance, Coinbase, Kraken. And when they're saying the whales are selling, it's actually inventory depletion as everyone's buying coins. And it's not the whales are selling, it's just coins are leaving exchanges. So you really have to understand what's happening within the ecosystem beyond just that on-chain view. You need to know which wallets are exchanges, and you need to account for it. And sometimes they're not, in the exchange world, we do have on-chain signals, but no one's really identified MicroStrategy's wallet. So we just have to look at their corporate filings and Michael Saylor's tweets, for example. So yeah.
Mm-hmm.
PlanB, do you do any like heuristics around trying to like identify exchanges or different entities?
Absolutely, yeah. Yeah, a bit like Willy is saying, it's a tedious job, by the way. But the main addresses from exchanges, of course. And you can algorithmically indeed recognize, of course, if a transaction has like 100 inputs and 100 outputs. That's so you can cluster all those transactions and run them by known address lists. Yeah, we certainly do that.
Makes sense. All right, next topic I want to bring up is just views on the cycle moving forward. So we kind of talked about the anatomy, right? And now I think it gets a little interesting because Willy, I know you kind of stand in the camp of this is likely the last cycle, whereas PlanB, you think we have another bear market. So Willy, I guess we'll start with you and kind of lay your case out for what you think.
Yeah, I think that we're very accustomed to this 4-year cycle. Like a 4-year cycle of Bitcoin, you get a bull market, and then you're left with mostly a year of maybe 80% retrace. You then, you repeat the cycle again, and we've really much attributed that to the halvening, the reduction of new coins being mined and sold onto the markets gets halved. So we get this impulse of supply shock. There's less being dumped, and so the price runs up. And in actual fact, we've only had 2 cycles of 4 years. The first cycle wasn't a traditional cycle. If you look at the structure of the market, the miners didn't even sell. They were if you're in 2009, as of 2009 January onwards, you could mine it, and everyone was doing everything they could to mine the coins, and they didn't sell because first you couldn't sell, there was no markets, and then when they were available, they still didn't sell. They were still mining because they were believers. So the first cycle was not marked by any mining sell pressure. And it was just sheer vertical wall for years because there was very little selling. And that marked our first cycle. And it was not like any other, cycle. It was very much an outlier. It was vertical. And then we had 2, what we typify as our normal 4-year cycles, where we had an accumulation range, a sell down, very hard sell down, 80, 90% or even more. I think the first one was even I don't know, it was over 90%. And then we did it again. We sold down in the 2014 era, and then we had sold down in the 2018 era. And everyone's thinking now it's going to happen again. But if you were to look at, like, remember the 2 really typical textbook perfect 4-year cycles happened powered by the halvening, which is a reduction of the mined coins being sold onto the market by half. And 2017 was the last bullish impulse we had from that, where I think it was pristine, right? As of 2018, we had our futures markets developed, and BitMEX started to take the majority of the volume. And then you look at the money that they make. BitMEX, of course, trades in Bitcoin collateral, everything's Bitcoin. And so here, BitMEX is making billions of dollars. They're doing billions of dollars of trading per year, per day. Of course, what are they doing with that money? Maybe some of it's held, but a lot of it is sold to cash to pay for the operational side of things and the founders' luxury expenses. So a lot of that money is being pulled out of the ecosystem, sold from Bitcoin to cash, and that effectively is a tax on the network and then sold to fiat. Like I'm going to tax anyone who's trading on BitMEX and I'm going to sell it to fiat. It's a net sell pressure, no different from mining. Mining is a tax on the network, meaning that I'm diluting the supply. So it's a hidden tax on the network, and also a fees tax on the network who's transacting, and I'm going to sell it back onto the market to pay for my mining overhead. So those two fundamentals are no different from each other. If you're a business that's earning Bitcoin on the network and you have to sell to fiat because you're paying salaries or you're needing to do that, because we're not in a world where Bitcoin is the currency. We do sell to US dollars to buy stuff. That effectively is the supply side equation to Bitcoin, a constant supply side, unlike investors buying and selling, right? This is a constant. Like the infrastructure of Bitcoin is relying on miners, exchanges, and now ETFs, and all the complexities of the loans markets. These are parts of the ecosystem which are businesses that, for the ones that generate income in Bitcoin, that some of that is going to be sold. And so as the ecosystem develops further, we're going to have more and more of the infrastructural sell side. And that infrastructure was very simple in 2017 and earlier. The only infrastructure really of dominance was mining. Now derivatives and options, and even Grayscale ETF charging 2% fee is 4% of the mining network and sell pressure. So when you balance that out, like the halvening in a year and a bit, 2 years, I forget, that is now not going to be a halvening because you've got all this other complexity of the infrastructure that is making Bitcoins taxing taxing's harsh because they're providing services, but they're earning and then they're selling. So the next impulse to drive the next so-called cycle, is not going to be an impulse. It's already, I'm calculating already the mining is equal match to the exchange's sell pressure on a kind of a low volume day. So we're in an era where what the exchanges are doing in their volumes, they're kind of more dominant. And if it's highly volatile, if say it's screaming upwards, then there's going to be more sell pressure from those exchanges. And so the demand supply equation's changed, and anyone who looks at the chart closely will see how choppy it is and how we're not really templating the 4-year cycle currently, because you would have thought, most people thought near end of this year would be end of this 4-year cycle, but instead we had this a mini bear cycle pulling back from 60 to 30, and that's just taken all of the FOMO and highly speculative nature of the market out, and we've had a total reset, and things are quite cool right now, yet we're gearing up for another run. And I think we're going to see more of the same, that we're going to get a run, and then the wind's going to be taken out of it, and we might get a pullback, and it might take 4 months to recover, and it might be a 50% pullback. Or I think that's the sign of things to come. We'll still have bull bear markets. I don't think they're going to be these 4-year macros. The 4-year thing is like, I think of it like planets in orbit. Bitcoin is a planet with a 4-year orbit, and that's created by its own kind of internal gravity. And now there's all these different forces pushing it, and they're running on different cadences. And eventually, and what we're doing right now is breaking free. I think we're breaking free from the 4-year internal gravity of Bitcoin and being pulled into orbit around traditional macro cycles, which are, 10 years or longer. And, we'll still be in a cycle, but it's in orbit with all the other large asset classes as this thing starts to get heavier and heavier, and the traders and the investors start to reflect the traditional world.
Plan B, any thoughts?
Yep. I, it's a definition question, of course, which we maybe should do, but it's a timing question as well. When is what is hyper Bitcoinization? What is a cycle, and when will it happen? Because that's for an investor, of course, the important thing. But yeah, I look at it a little bit different. From a pure investment point of view, I would say first that drops of minus 50% and minus 80% will happen again, just because the volatility is in the market. It's a part of Bitcoin. No other market has this volatility. There are, we had a minus 50% drop with the mining ban thing a couple of months ago. That was, well, not a really big event, but still a structural event. But minus 50%, right? So I think things like fear and greed in investors and people will be here to stay. Humans will not be different, and they will freaking out again when maybe the US bans it. Well, I don't think that's not going to happen, but something will happen. The introduction of the central bank digital currencies, the tightening news of know your customer, and you can't exchange it to fiat anymore. Whatever, some bug, some big entities selling because they don't believe in it anymore. I don't know what the trigger will be, but there will be panic, and people will freak out. Liquidations will come, and it will drop down. Yeah, I think that's part of the market. That's part of the charm as well of Bitcoin. So that will happen. That's the one thing. So greed and fear are here to stay. Minus 50%. We just had that. Minus 80% wouldn't surprise me. The second thing is, I reason from stores of value. So alternative investments. If I have a large sum of money, what are my alternatives? So it's equity, it's bond, and if you look at the commodity space or the non-financial asset space, it's gold, and it's real estate, basically diamonds maybe, but yeah, and so that's of course the stock to flow X model. I'm reasoning like an investor, like why would I put my money in real estate, or why in gold, or why in Bitcoin? And there are several aspects to what makes a store of value or money better than another one. And one is the visibility, another is portability, the classic fungibility, and scarcity. So I am not surprised at all that the real estate market is just so much bigger, larger than gold market. And I'm also not surprised that Bitcoin is a little smaller than the gold market. But as soon as Bitcoin, after the next halving, or really this halving, we should get really close to gold market cap. And after next halving, it would really surprise me if an asset that is recognized by the market as a store of value, that has, say, more than $1 trillion in value, if that store of value with bigger scarcity than gold would not at least be valued higher than gold, so somewhere between gold and real estate, 10 trillion and 100 trillion roughly. So in that sense, I think differently about the 4-year cycle. I think it's not, so the halving is important, not because of the miners selling, the sell pressure from because that's already neglectable. Like Willy said, I mean, a big exchange is maybe bigger than some of the big miners, and add to that the ETFs and all the other sell pressure. So I think the selling pressure of the miner is not the thing. I think the fact that the scarcity is larger than gold is a fact, and investors notice that. They know it. Investors know that if the yeah that if gold can be made, if there's a new gold mine, of course that takes years to make it operational, but it can be found, a new source of gold, and then there will be a big supply. In fact, supply of gold has grown over the years, but with Bitcoin, you know for sure that that will never be more. So basically, this is it. There's 19 or 18.8 million Bitcoins. And that approaches the 20 and then the 21 million. But this is it. So yeah, it is from a scarcity point of view, and alternative investments like gold and real estate, that I think that the halving still will be an impulse for investors, because they will recognize and see Bitcoin for what it is, a really scarce asset and valuable at that. Then to conclude, I do think if the stock to flow of Bitcoin will be bigger than even real estate, so above 100, and that basically is the case after next halving, but and certainly after the halving in 2028, but let's say 2024, when we go over real estate, then it will be the most portable, most divisible, most fungible, and also the most scarce asset on the planet. I think investors will see that, and that combination will probably mean that people are going to see Bitcoin not as a store of value, but as a money, and that will trigger the hyper Bitcoinization. So you could also say that Willy and I are saying the same thing. The hyper Bitcoinization will be there eventually, but I think that will happen after the next halving, and after Bitcoin has at least a stock to flow of 100 and maybe 200, but much bigger than real estate.
Yeah, I think I agree with that. I mean, like, I think that we're looking at pretty much a 4-year from now to really, have Bitcoin as a main contender on the world scene as a new money, or definitely a large macro store of value. Yeah, and it's interesting because the next halving brings Bitcoin to the inflation rate below gold, and so it gets pretty scarce. And yeah, one more. Like, I think when I talk about the cycles, I think we agree on the destination, where it's going. I think there's just different views on the shape of the chart. Whether or not we have the painful 1-year drawdown of 80%. And I think that's the difference of it is how, and a lot of people have said, does it invalidate stock to flow? Well, of course it doesn't, because that's just based on the scarcity valuation, which doesn't change. It's just how does the price sort of meander in its shape, which is, it's a very, important point for people who want to time the market and want to sell the top, like, I did, PlanB did for 50%. And
it's interesting, Willy. It means we're back at that risk measure point, right? It's how do we and the options in there. So will there be a minus 50 or minus 80% drop again? It's a risk thing, basically. So that the endpoint is, I think, clear. It will the trend is clear. It will go up, but how will we get there? And will there be minus 80% drawdowns? That's the
exactly.
big question.
It's all about the risk. It's all the downside, and how much you're willing to withstand. And I think there's more than that. It's like, there's times when I'm trading and the trade is going against me, and I know it's going to swing back because I've got the fundamental data that's like very, very strong. And I'm like, well, it's going to swing back, but I will sell down my position to mitigate the downside risk. And the reason I do that is not because I don't believe I'm going to win this trade. The reason I do that is because I know ahead of time, if it goes below a certain level, I won't be able to stomach that level of downside whilst keeping a clear head. So I'm actually proactively, I know my risk tolerance pretty well, having traded for so long, and I'm going to take some money off the table, downsize the risk so that if it hits lower, I'm really going to make a less emotional, I'm going to make a decision more rationally rather than out of fear. So like, it's like that, I think it's not only understanding risk, but it is really much understanding how your behavior is going to happen. Like how is it going to play out with the road ahead, which is really important.
Yeah. And one thing I'll be looking at like a hawk is the option markets that we talked about before. Because the option market is a risk market, is a volatility market. That's basically trading volatility as an asset. And I pulled up the numbers right now for September options, September next year. So a year from now, almost. The implied volatility is still above a 90%, between 90 and 100% implied volatility. And I guess if or when the markets, because both of us can be right? If the super cycle, the hyper Bitcoinization sets in, and everybody, the market is convinced it will go without those minus 50% or 80% drops, then that implied volatility in the option markets will be the first signal, the very first signal, because they are directly trading that as an asset, where the implied volatilities will drop. That's what I think. And right now they're at 90, 100. So that's really high.
Yeah.
So
I've seen
I guess
this
the
really
market.
interesting. I've seen this really interesting chart that I think Dylan LeClaire posted, and it was essentially that the German mark measured in gold chart, right? PlanB, you posted this before, and you've overlaid Bitcoin's price with it. When you actually look at it in terms of like the non-smoothed out version, if you will, and what you see is like there's extreme volatility in that time. And so my framework for moving, Bitcoin moving forward, and part of the reason why I mainly am just sitting in spot is because I think throughout this process, you'll see that increased volatility. It's almost like, as a rocket ship is taking off and leaving orbit, you have really violent movements before you finally get out of, the orbit of the Earth, before you break through the atmosphere. I think it's very similar in the sense that you'll see really aggressive volatility because at some point, Bitcoin is basically measuring the debasement of the USD more than anything. I mean, I think you could say that it already is, but I think that, eventually it'll just be reflective of that the same way that, gold was for the German mark in that chart.
Well, I think I look at it the same as you, as that it will keep the volatility. But there's a lot of people, very big investors, maybe more than half of all the traditional investors in Bitcoin, that see it differently. They see a larger market value, a larger market cap will bring lower volatility, like Amazon and Google. So you have some volatility in the beginning, just after the IPO and before the IPO, of course, but you can't see that. But just after, and if it dips like 80, 90% after that, the skies are clear and we can take off. And normally, right, in traditional markets, when you have a bull market and it takes off, Amazon, Google, Facebook, whatever, the volatility will drop. But the scenario that you are describing, and I agree with you, is not like Amazon and Google. It's more like that gold, the German Deutschmark paper mark that just and that just died, right? It died. Nobody wanted to have it, and the sooner you could get rid of it, the better. And it just died. And I think, but that's a geopolitical thing. I think that will happen to the dollar in the end as well, but not next year or the year after.
All right, guys. I know we've been going on for a while. Willie, I know it's getting a bit late for you. So last question for both of you. I like to ask this, to everybody who comes on the podcast. What milestones do you see as being the most impactful when we talk about the acceleration of hyper Bitcoinization? So, for me, I'll go first. Like the first two I think of is El Salvador, right? And kind of the first domino in the whole, game theory of state level adoption of Bitcoin. And then second, I also think the politicalization of Bitcoin will be really interesting as well. I think you're just starting to see that. We had a New York City mayor that just got voted in. He's a big proponent of Bitcoin. And so I think when you start to see that, you've got like Cynthia Loomis and some of these other folks. So I think when that really takes a force in the political landscape, I think that'll be another key transition point. Willie, I guess we can start with you and then Plan B.
Yeah, I think it's very similar. I mean, El Salvador is the first sovereign state to recognize it and even hold it in their treasury. And I think the next milestone is really to look at a wealthy, industrialized nation that holds it in their sovereign wealth. Because I think that's interesting, because then you got to sit at the table at the sovereign level who are going to bat for Bitcoin against like banning it or regulating it out. I think that's important. It'll add comfort to a lot of people coming in. And I think in terms of a metric, I think the next milestone really is the distribution. To have that distribution be less concentrated and start to reflect something akin to what we see within the fiat world, and then further distribute. I think that's one of the most important things. Everything within Bitcoin is very reliant on decentralization, and decentralization of the wealth base is just as important. So right, I think that would be a kind of non-visible political milestone. It's non-political milestone. It's just a metric where we just cross, and like now it's more spread than fiat. And then, hopefully it continues to spread and we have a better distribution of wealth in the world. That's my hope. Let's see how it works. Currently, it's more just concentrated, but I'm seeing every year that the whales sail down. And eventually we'll have succession. The original rich whales will eventually pass on in their inheritance to the next generation. And so, I think we'll get there. Plan B.
Yeah, predicting is difficult, but predicting far in the future is even more difficult. One thing I learned is that even 2 years into the future is so difficult. If you look back 2 years, right? If you look back at the end of 2019, I would have never predicted COVID or the whole thing around that. That's not even 2 years ago. So I think what will happen and what will be the big accelerator for Bitcoin and a lot more things with it is something we don't know yet. Something that will pop up next month, tomorrow, 6 months from now, that will alter the entire scene. It could be climate change. It could be a cyber security leak thingy scenario with attacks, and then all the banks, all the money is gone. And of course, Bitcoin is the only network that cannot be hacked and attacked. It's something we cannot even think of right now that will trigger that hyper Bitcoinization.
Do you think about tail risks?
Yeah, tail risks.
Like I think it's a tail risk that Bitcoin doesn't succeed. I think it's more like, it's already at a level of success where it's going to get to the next level.
Yeah.
But the tail risk is if something breaks and then the next day it's gone.
Yeah. The tail risk. Yeah, there is tail risk. But I agree with you. How I see it is Bitcoin is the better money. It's the better store of value. It's mathematically, thermodynamically, it's the best there is. So it must succeed. It has to succeed. It can be stalled. It can be sabotaged by political things, by military things, but it is physically or thermodynamically, it's mathematically, it's the best thing there is. So it would be like saying keep saying that the earth is flat while it is round. One day you cannot hold that ball under the water. It has to pop up. So I fully agree. Bitcoin will go higher and higher, and there is still risk, but I think it's
But we can't see it by
inevitability.
definition, right?
Exactly. Yeah.
Yeah, what's the saying that the biggest risks are the ones you don't know, right?
Yeah.
That's it. And that's the same is true for the biggest opportunities. So I think the next trigger, it will pop up. One day we'll wake up and then there it is. Changes the whole world.
Exactly. Not far away, really, with the rate of progress.
True.
Well, guys, thank you so much. We're going on almost 2 hours here. So, I just wanted to say, I really appreciate you guys coming on, and this was a blast. I've been, I had a hard time sleeping last night because I was so excited for this conversation. This was pretty epic. So, I mean, I don't think you guys really need to plug in your Twitter, but if you want to give any, like closing remarks, or Willy, if you want to plug in your newsletter, PlanB. I know you now have another Twitter account with all your different content on there. So if you want to just give a quick plug into some of those things, Willy, go first and then PlanB.
Oh yeah, most people know I'm on Twitter, Woonomic. I publish stuff there, research, thoughts, musings. That's really it. I have a newsletter. You can subscribe if you want. It's on my profile page. But yeah, I'm like, I pretty much do a lot of my research and put it out for free, just for fun. So PlanB.
Yeah, the Twitter account, everybody knows that, I guess. But I'm, after that last interview with Pomp, where YouTube took out banned the video, deleted the video, and took out his channel, I'm a bit more afraid that might happen to me. And quite frankly, with the size of account, the number of followers that I have right now, I have daily attacks, right? People reporting me, trying to take my channel down, my Twitter account down. So we have a second channel. It's at 100 trillion euro, EUR, at 100 trillion. It's Louise. She's my COO. So in case of emergency, if something happens, if my account is gone, she'll be the first line of contact, and we'll have a website too. The website is planbtc.com. That will be a point of communication in a case of emergency. And of course, all the interviews and articles are on planbtc.com as well. Hey, and Will, thanks for organizing this epic talk. We should do it again.
Yeah, absolutely. And this was a blast. I'm definitely going to have to go back and re-listen after we edit it and stuff. But thank you so much again, guys, and take it easy.